Hello everyone. So till now we have discussed about the initial business plan creation, then we discussed about the sales marketing part. Okay. Now comes the most important thing, which is financial management. Because most of the founders, if you are not from finance background, financial management is something which is most important for you to learn. And even if you are a student, you have some experience in industry, or you are a retired founder, but you are a first time founder and watching this, listen to this carefully. See, main purpose of business is money. And when we are doing this, is our sole purpose, that money should continuously flow to the business. How it will flow? The purpose for which you have started business. Okay, people are ready to pay money for it. Okay, this is what we discussed in the very first or second video when we started our journey. So the most important thing is your why is sorted, your ikigai is sorted. Money should actually come. How it will come? Once you start taking actions in the right direction. So the right set of actions, like you have to create your online presence, you have to generate leads. Details about it we have already discussed in the marketing and sales related part. But what actually matter will be the cash flow management. Like your pricing strategy is the most important. When you are pricing your product or service, also consider the cost part of it. Okay, so whenever you are pricing your product, always have the cost as your consideration, and put your time value as well. Whatever value, like if you are developing a software, definitely the cost of the development and maintenance has to be incorporated in that. If you are trading or selling goods, the cost of acquisition, transportation cost, okay, return charges, whatever additional things are there, include everything. And if you're a service provider, always include the cost of your operations team, your sales team, marketing team, as well as if you are personally involved, then charge your cost as well in that particular service. Okay, so that you have a correct profit. While calculating, you have a correct picture about the actual profit you have made from that particular transaction or overall business. Okay, so this is the main thing which every founder has to keep a note of. Always keep in mind that there is a difference between profit and cash flow. Both are not same. Profit is accounting profit, while cash flow is the actual cash you have earned as a business. Okay, so always ensure that you are, while creating your budgeting, also always create the projections through profit statements as well as cash flow statements and compare them with the actual ones, and always have a cash flow statement with you. Okay, this is really important for you. Now, budgeting and cash flow management. So budgeting, develop a comprehensive budget that aligns with your startup strategic objectives. Carefully you have to track and manage expenses to ensure the efficient resource allocation. So this, if you remember, while creating business plan, we have done this budgeting, that this much is expected to be incurred for starting this business. The same thing has to be done for running the show on monthly basis, or maybe like you have to create your budgets for fortnightly, weekly, monthly basis, depending upon your business. And cash flow management is something that you have to keep a close eye on your cash inflows and cash outflows. Actual cash inflows I am talking about here. I'm not talking about revenue booking. Is a myth. When customer is paying you the money, that is what will matter for you as an organization. Okay, so always make sure that your cash flows are intact. If inflows are not happening, outflows are exceeding inflows, definitely it will be really difficult for you to run the show, and your operations might die, and you as a startup might fail. So you have to closely look into your cash flows. Always have buffer when the period is good. Okay, keep that cash flow in some separate current account of your company, so that you have a cushion in bad times. Okay, make sure about it. Then comes the forecasting part. So use financial forecasting to anticipate your future cash needs. Okay, so whatever cash you as a business you're expecting, that this much I will be getting, this much I have to pay. Always anticipate this, that if your inflows are lesser than your outflows, so you have to immediately work on things to make your inflows increase. Okay, there you need to revisit your plan and you need to rework. You may need to add up some more services, you may need to add up more customers for existing services. That is how it will work. Okay, so the next part comes is the financial forecasting and projections. So you have to forecast your revenue, that how much sales as a business, like how much will be your top line. Okay, accurately you have to project it. And That should be done considering that how your customers are responding to you, how the market is responding, overall sales pipeline data that you have currently. Okay, because that plays the major role. Because if you have proper sales pipeline and it is expected that conversions are going to happen in a coming month, quarter, definitely it is a good sign for you as a business. If it is not there, then you have to work immediately on that. Secondly comes the expense modeling. So we have to see that future operational, marketing and personal expenses to create a comprehensive financial model. So you have to see that your marketing, because once you put money in marketing, you will start getting the leads. Once you do the conversation with those leads, your pipeline will start getting created, and once you do convergence, then inflows will come. Okay, this is how it will happen. But what you have to do is that your marketing and operational expenses should be there at least for next 6 months with you. If it is there, it is easy for you to run the show easily. Okay, so 6 to 9 months ka marketing and operation expense should be there. Runway means I will recommend to have a runway of at least a year, but minimum 6 months runway should be there. Okay, then comes the scenario planning. So you as a founder, you have to make sure that you develop multiple scenarios, like 3 scenarios I'll tell you. Best case, what will happen; moderate case, what will happen; and worst case. Always be ready for the worst case while planning for the revenue and sales part, so that you put, because even if best case happens, you will get good revenue. If worst case happens, at least you will be safe and secure as a business. That is what you have to ensure. Okay, so next comes the terms like burn rate and runway. So you should understand that the rate at which you so you need to ensure this. So you need to ensure this, that as a startup, the rate at which the startup is spending its cash reserves. Okay, typically on monthly basis, generally it is called as that 2 lakh is the burn rate. Okay, means you are burning the money, not earning the money. Okay, means your revenue is say 1 lakh, expenses are 3 lakh, 2 lakh you are burning. You are getting my point. So burn rate should always be lesser. And since we are working on making a startup profitable from the day one. Okay, so in our case, though, this term itself is of no relevance. There are always good times and bad times in business. Even if we are working to make a profitable startup, but market is not supportive. You remember during COVID, okay, all the SME startups have suffered. Okay, so if that kind of a situations are like situation can come anywhere, like monkeypox can news coming right now. So if that kind of a situation occurs, so you should at least have some cushion available. Okay, that's why this burn rate term you should know. Okay, even if you are making zero revenue, what are your costs? Always try to keep those costs minimum as possible. Try to work in a frugal way. Okay, then comes the runway, the estimated time a startup can operate before it runs out of cash. Okay, as I mentioned, that you should have a runway of at least 6 months. Means you should be able to meet up your expenses for next 6 months, because cycles change in the business. Okay, it's not that every time it will be a bad market only. Okay, so 6 to 9 months it's preferable, but if you can make it till 24 months, nothing as a bad deal, right? You can have definitely for more period. Then comes the monitoring. So you have to continuously monitor the burn rate as well as the runway. If burn rate is under control, it is on the reducing side. Your runway is good, like you have ample amount of money to run your show, then it is good for you. Okay, otherwise it is bad. Then comes the break even point. So in the initial stage, so this term basically break even is used that when in the initial stage of your business you are putting out money. Okay, and you are like putting say 10 lakh rupees in the business. Okay, so for 3 months initially no sales are there because you are developing some product. Now these 10 lakh rupees that you have put in these 3 months, okay, so this is your capital. So you should be very clear about the terms, but you will be putting some operational expenses. You are incurring some expenses on travel, on hires, like the people who are added into the team, or consultants to whom you have paid, vendors to whom you have paid. So all these payment that you have done, okay, those need to be added for these 3 months. And suppose these are coming 3 lakh rupees. So till the time you are not breaking even, means till the time you are not reached these 30 lakh rupees that you have put in the business, okay, you are not in profits. So make sure whatever amount you are putting, total capital plus operational or variable cost, whatever you are putting, all should be covered up. Okay, for your particular business, then only you will be crossing the break even. Okay, suppose your product is to be sold at 2000 rupees. How many units you need to sell to reach the break even? So if it is 13 lakh, so 13 lakh you have to divide by 2000. Okay, 2000 is your selling price. So in this case, 13 lakh divided by 2000 will come as 650. Okay, so you have to make sure that at least 650. One second, is it 650 or 6500? Just a second. So yeah, correct, 650. Okay, so break even, definitely it is a very good metrics to analyze that you are going in the right direction. Okay, then comes the importance of accounting and bookkeeping. People undermine it. This is the most important thing that need to be done from the day one itself. You need to hire a virtual accountant or in-house accountant, but make sure that your books of accounts are up to date. Okay, because if books of accounts are not maintained, you will not be able to track anything. है ना? So for accurate financial reporting to the government, for your tax compliances, and for your informed decision making, you need the accounting and bookkeeping intact. And investors have confidence in your business only if you are maintaining your books of account and you have all the data figures in control. If you don't have, then definitely you will not be able to get the funding also. Okay, so that's why financial management is most important for you, and we are helping out startups in doing all these accounting bookkeeping stuff from last 8 years, and we know how important it is. Okay, so from that perspective also I am telling you this, and you can always outsource this. It's not mandatory to have permanent or full-time accountant or finance guy as a CFO from the day one. You can take virtual CFO services from us, from anyone. Okay, from all any of the service providers. Okay, then comes the tax compliance of startups. So the registration, the proper filing, proper tax planning. So these are the three different things. Registration is required. Suppose you are crossing your turnover beyond 20 lakh. You are doing exports outside India, whether of services or goods, or you are doing a e-commerce sell. Okay, in that case, registration of GST is required. I'm giving you an example of GST. Okay, there are 21 states in which PT is mandatory if you are doing a business there. Then comes proper filing. So if you are registered, you have to do a proper filing. Suppose for GST, okay, same for PFESI. If you have registered, you have to do PFESI filings. And then comes the tax planning part. Definitely you have to efficiently manage your tax. You have to work with your chartered accountant. Again, tax plan is something in which we also help to our clients. If you need any help support, you can reach out to us or anyone. Okay, I'm not saying to reach out to us only, but this is something which is mandatory for you. Okay, don't ignore any of these things. These are very, very important for you to run your business, because ultimately for finance only, for money only, you are doing this. Okay, then comes the funding options and financing strategies. So equity financing, debt financing, grants and subsidies. So these are some of the things which are available as an option for funding. And equity financing generally will be given after doing proper valuation of your business, which you will get done through the registered IBPI valuer. Again, this is something that we do for our clients. And then comes the debt financing. Debt financing is also something which banks do generally. Equity financing is done by venture capitalists or venture capital firms or angel investors, which we have discussed earlier. And debt financing is done by banks or online lenders, and grant subsidies are generally given by the government. Okay, so all three options are there to you, available to you as a founder, as a startup. So all these three options are available to you as a startup. Then financial metrics and KPIs. So you need to ensure that your revenue growth is happening, and it should happen at a rate at which startup revenue means at a good rate. Okay, you have to compare it with the industry also. Okay, you have to see that effectiveness of your startup sales and marketing will be evaluated through your revenue growth, because ultimately all the efforts that you are putting in your marketing and sales are leading to increase in your revenue. Okay, then comes the gross margins. You have to ensure that the profitability part is at the core. Okay, as I mentioned earlier also, you need to make sure that your gross margins are good. At least 50-60% gross margins should be there. Then comes CAC is the cost of customer acquisition. Okay, and customer lifetime value is the revenue that you are expected to earn from that particular customer that you have got. Always ensure that the customer lifetime value should be more than customer acquisition cost. If it is not more than this, you are going to die slowly as a startup. Okay, then comes the conclusion and key takeaways regarding the financial thing. So we have discussed about the fundamental things. applicable to you as a founder, like what all things you should know from the finance side, how you have to do the budgeting, how you have to manage the cash flow, and why cash flow is more important than profit. Also, we have discussed about related to the finance, compliance reporting importance, and the importance of accounting and bookkeeping. है ना? So these are the important things that we discussed. Because if you are going for a funding, whether for equity, for debt, or even for the grant, the government also takes your fund utilization plan, financial projections, and they may ask for your filed financials with various departments. Okay, so make sure that you are fully having control on your finance accounting part, and you are managing your cash flows well, because that is the ultimate purpose for which we have started our startup. Hope you have understood the aspects of finance through this, and we'll meet you in next video.